All right, we're going to give it about 30 more seconds and then we're going to get started. All right. Okay, I've got 12:01, so I'm going to go ahead and get going. And then if we get any more people on, we can just let them in as we go. So good morning, or actually afternoon. It is now afternoon, everyone. So thank you so much for joining us today. We're going to do a quarter 2 market update. This is going to be a great call. I'm really excited to hear what we're going to hear today. So I want to give a special thank you to Matthew Terry from Horizon Investments for helping coordinate this. Today, we will be hearing from Zach Hill. He's the head of portfolio management at Horizon Investments. Zach Hill received both a BA in physics and a BA in economics from the University of Virginia. He's also a CFA chart holder. Currently, he oversees the implementation and communication for all investment strategies managed by Horizon. So without further ado, Zach, please tell us what's going on in the market and what has been happening in quarter 2.
How much time you got, Lindsay?
I know.
Thank you all very much for having me here today. It's a great opportunity, to be in front of you and just kind of talk about what's going on, because certainly right now there is a lot going on. So what I'm going to try to do today is cut through a little bit of the noise and all the kind of stuff you hear in the media, and kind of bottom line for it in terms of how we're seeing things on the stuff that really matters. And there's no real secret to that. Inflation is at the top of that list. The Fed is certainly up there as well. And in addition, kind of what the growth outlook looks like for the rest of the year. So kind of mark those to market and kind of where we are, what we're looking at there, and then just kind of provide sort of 3 different scenarios and what we think kind of market implications are going to be from there. Doing that just because in this very highly uncertain time where things are moving really, really quickly, it's often a little bit easier to think about, scenarios rather than a central tendency type of forecast. And so I'm going to do that for 15, 20 minutes. I'm going to leave plenty of time for y'all to ask questions. I find generally these things are better if you are engaged in asking questions. And so feel free to drop anything in the chat box while I'm talking, or afterwards when we open it up to questions. Please don't be shy. Before I start talking about kind of where we're seeing in markets, I want to talk just a little bit about Horizon Investments. We're a goals-based asset manager based in Charlotte, North Carolina. And what that means to us is it's really very kind of basic, I think. And we over the years, we were founded in the 90s. Over the years, just having conversations with advisors, realizing that the stuff that was developed in the 1950s, modern portfolio theory, all that, while it's really intellectually rigorous and very appropriate for something like a college endowment or a pension fund, for you and me, someone who has a finite lifespan and changing, goals over time, it's not really appropriate. And trying to do that plug and play type of situation is just really, really difficult. And so we took that feedback back and created what we think are some really unique and really intuitive strategies that are specifically geared towards the 3 main stages of an investor's life. That beginning stage where you're accumulating assets, that stage where you have your couple years before retirement, and you have as many assets as you've ever had in your entire financial life, And the risk then is not so much how volatile your portfolio is, but can I sustain a drawdown, a 2008 style situation, and still be able to retire in the time frame that I was planning on. And then lastly, the distribution stage, or what we call the spend stage, is something that's becoming increasingly topical, as well as people are living longer and saying, hey, how can I make this work? How can I live off the assets that I've accumulated, maintain my standard of living as inflation continues to eat away at it over time, and do so in a way that can work for today's longer lifespans. We're in retirement, 25, 30 years is a very average thing these days. And so, we run strategies and portfolios that are specifically designed for these three areas. And as you can see here on the screen, I think our innovative approach and the way that we're able to deliver it has really resonated in terms of firm growth and also in terms of awards and things like that from various institutions and people that are looking after this sort of thing. In addition to being a really good place to work, which is something that we're really proud of, having this really kind of fun and culture, realizing we're doing a very serious thing here, but also trying to enjoy ourselves and kind of inculcate that culture that we want to have in our employees. So that's a bit about Horizon. I'm going to talk now about kind of where we are, what we're looking at for Q2 and how we're looking forward. So, the mark-to-market stuff, kind of where we stand today, inflation, that is very much on everyone's mind. We actually get the latest reading of the CPI report tomorrow. So we're potentially going to be 9% year over year, which is it's the highest we've seen since 1981, the highest we've seen in this whole cycle. So how are we thinking about that? How does that feed into the Fed? It's no secret the Fed has become really one of the more important, if not the most important player in asset markets over the last 10 or 15 years. And so watching what they're doing and kind of looking out and seeing how they're going to react is really important to predicting certainly what markets are going to do over the short and medium term time horizon. And then lastly, the consumer. Fuel of the economic engine in the United States, about 70% of the economy. So they're really, really important for looking at, kind of where things stand. So just as a quick mark to market on inflation, what I'm showing here is just a picture. You've heard about supply chains. You've heard about, issues with all of that. And really, it's not just supply chains. We've had a supply demand imbalance with incredible amount of demand, which I'm showing. This is in the manufacturing sector, showing that white bar there. These are just backlogs of orders. Those are orders that have not been filled. You can see they're starting to improve a little bit. That's encouraging. And then likewise, the supply situation, which is that yellow line, that's customer inventories in the manufacturing sector. They got really, really drained during COVID. So we're starting to see that come back. This is something that over the more medium term makes us more optimistic that we're going to see inflation come back to target. But really, it's taken a frustratingly long time. Quite frankly, probably too long, and certainly too long for the Fed. And so this is something that while it's on the right track and certainly has us medium term hopeful, it still is not exactly healed up as we would like it to be. The one area that I would say, and just a bit of personal advice, if as we're reading the tea leaves, if you look at stores, what stores have in terms of inventory, it was no secret. You couldn't find all sorts of things, televisions, computers, you name it, all during 2020 and 2021. All that stuff was just in short supply. Well, actually now they've ordered too many of them, and so that's what I'm showing here in this chart. Just a massive increase in the amount of inventory. And so we've seen commentary from the likes of Target and Walmart saying we have the wrong stuff. We have too much furniture, we have too many televisions and that sort of thing. So you are starting to see some discounting in those areas. So if you're looking to buy a new TV, maybe wait a couple weeks or months. You might get it a good bit cheaper than what it's listed at today. So again, something medium term encouraging on the inflation front, but we have some work to do. And the last thing is what does this look like for the future? And this is just a proxy for showing that, saying, look, orders are a lot lower than they have been, over this entire cycle. And so putting all these things together, it's a kind of a medium-term picture of healing supply-demand imbalances in the goods part of the market. And really, if you look at it, that's been the major driver of inflation that we have here today at 40-year highs. So how does that feed through into the Fed? This has been the whole main reason that we've had such volatile asset markets this year. It's just the incredible shift in expectations for Federal Reserve policy. We've shown in the past on events like this that we were expecting the Fed to hike interest rates 2 times this year. although if I go back to September of last year, we were expecting only two quarter point interest rate hikes. They're going to hike 75 basis points most likely at their next meeting. They just hiked 75 basis points, and so just a wildly off estimate because of how quickly the inflation picture has changed. And what I'm showing here is kind of expectations again that have shifted rather quickly. And part of the reason that asset markets have been so volatile is, look, we're going to have a very fast interest rate increase cycle. It's probably going to peak out towards the end of this year, and then the Fed is going to start cutting rates next year. I think this is part and parcel of kind of the volatility we've seen in markets for the last 2.5 years. I mean, the amount of superlatives around what happened in the COVID drawdown and how quick the recovery was and the amount of stimulus and all that kind of stuff. This is just another example of kind of how compressed this cycle has been and how extreme the environment has been. And now that we're still hiking interest rates this year, and we're expecting them to fall next year. And then lastly, the consumer. And I mentioned how important this was, for us, and we're spending more time on the consumer than we have in some time, because there's this really interesting dichotomy going on. And if you ask people, and I'm showing it here on this chart, if you ask people, how they feel, they say they feel awful. They feel as bad as they do during recessions, during 2008, during 2000, 2001. But when you look at things like what our incomes look like, or what the balance sheets look like, what does net worth look like, it looks really, really great. And so, also the job market is quite firm. I mean, if you want to get a job, you can just go out and get a job. And people are getting wage increases by and large to keep up with inflation. And so what is it that's kind of making people feel so bad? And that's what I'm showing in this white line here, which is expectations for prices over the next year. There is nothing more topical than how much it costs to fill up your car with gas. And like it or not, that is what people are responding to. They're saying, "Wow, it's costing me a whole bunch to do this," or "I need to dial back my thermostat because there's not enough power on the grid right now." Those types of things make people very upset and make people feel really, really bad. And so, what we're watching really, really closely is how consumers actually behave. They say they feel awful, but they're still spending money. And so kind of resolving how that dichotomy plays out for the rest of the year is really, really important, thinking about kind of the growth outlook. So putting all that together, and like I said before, given how uncertain this environment is, I think it's much easier to talk about things in terms of scenario analysis rather than this is exactly what's going to happen. This is the kind of the point estimate of the future. And so I think there are three real scenarios that I'm going to talk about really quickly here, and kind of the market implications of them. The first one is sort of a rapid deterioration. That would be like the high risk scenario. That's things get worse quickly. The kind of the middle of the road scenario is a slow improvement. That means things don't look great today, but they slowly get better over time, and maybe get sort of back to normal by the middle of next year or something like that. And then the probably the lowest probability scenario in my mind today is the rapid improvement scenario. That's where things just get better rather quickly. That's likely going to be something that is exogenous to the overall backdrop. I'll talk about what that might look like in a minute. So I'm going to just dive in kind of real quickly in terms of signposts that we would watch here on each one of these. Just give kind of like a high level thing. If there's one thing to watch on this, kind of what would it be? So in the rapid, the rapidly degrading situation, that's things getting worse quickly. That's inflation staying, around where it is, 1% or so, 0.7% month over month, which translates into really substantial year-over-year inflation. That's a 8 to 12% kind of year-over-year inflation. Way too hot. This is just not something that's compatible with price stability at all. In that situation, you would have the Fed being much more aggressive. As I said here, hiking with no end in sight. And that's going to eventually start to hit economic growth, start to hit the labor market, and going to cause issues across market pricing, stocks and bonds alike. And so in this scenario, we would expect global equities to continue to trade poorly as they have all year. We would also say that the high in yields has not yet been seen in this scenario. There would be more pain in the bond market, and certainly credit markets, corporate credit would not do well either. The only thing that might do well, at least in the short term, would be commodities, just because of how high inflation is. They're very, very inflation sensitive. But that would be short-lived because eventually you're going to go into a recession, you're going to crush demand, and you're going to see commodities roll over. So if I had to look at kind of one thing on this rapidly deteriorating scenario to say, hey, are we moving in this direction or are we not? It would be this month-over-month inflation print. So, you can see here, kind of pre-COVID, when things were much more normal, we were averaging around 0.2 to 0.3, sometimes a little bit higher, sometimes a little bit lower. But it was generally compatible with about 2% inflation, which is what the Fed targets over long-term horizons. And so we were very much in the ballpark of that kind of pre-COVID, and we've been nothing near that since. A huge contraction when we were all locked down in our houses, and then a spike up after that, and then more spikes, and then continued high month-over-month prints. And so if there's one thing that I'm watching, and certainly we on my team are going to be paying a lot of attention tomorrow, is what the internals and the month-over-month figure looks like on the inflation print that we're going to get tomorrow. So I'm going to skip forward here a couple things in the interest of time. Our most likely scenario in terms of what we think is going to happen in the medium term. And so that would see inflation falling down into that 0.2, 0.3% month-over-month range, which is what I was talking about earlier about kind of where things were in the pre-COVID times. And that would allow the Fed to not be quite as aggressive as markets think that they're currently priced for. That would also kind of get rid of some of this malaise that's hanging over the consumer. It's not going to hit the economy too badly. Consumers are going to keep spending, and growth is going to continue to chug along. And so, where will we say that from a market implications perspective? That's some choppy, range-bound, equity markets for the near term, but likely going to be headed higher as we get towards the end of the year, beginning of next year. In that scenario, when we can really say with certainty that we're starting to heal rather meaningfully. Yields roughly range bound in this kind of scenario. They might go down a little bit, but not much. We're kind of fairly priced for this sort of medium risk scenario. And credit spreads would be a place that would improve, slowly at first and then dramatically. And so that's kind of how we're thinking about this medium term scenario. And again, outside of looking at the month over month inflation numbers, what I would look for here to kind of say, hey, is this starting to come back into balance, and is this the most likely scenario that we're going to see? Is what I'm showing here, which is the labor force participation rate for prime age people. And so, these are your prime working years, 25 to 54, years old, and you can see we had just a huge contraction in the labor force in COVID, and it was 3% at its widest, and this may not seem like a lot, but given 160 million people in the labor force overall, and a population of 330 million people, this is a substantial number of people that are missing, from the labor force, and this is part of the reason when you go out to a restaurant or whatever, go to a store, everyone's understaffed, everyone seems like they're new, they don't know what they're doing. And it's causing businesses to have to bid up wages in order to have that labor working for them. And so if we were going to see things start to heal, this is something that we would really kind of get back into balance in terms of the labor market, and the supply picture. While it has come a long way, would be something that would make us feel a lot better about coming through in terms of this medium risk scenario. And then in the rapidly improving scenario, last but not least, as I said, kind of the lowest probability of that, and certainly not something that we are positioning for today, because the driver of this things get better quickly type of situation is something that's just inherently very difficult to predict. So that would be either or both of these two things. the end of the war in Ukraine or the end of the China zero COVID policy. Both of those things happen at the same time. You see a major relaxation in commodity prices, major relaxation in inflation pressures, and would allow the Fed to pivot toward a much more neutral stance. It would assuage some of these fears that we have around economic growth, and especially if China were to come back into the fold, the Chinese economy really start to get going. That would reaccelerate in terms of kind of the way that they're thinking about their economic policy. And so this would be the situation where equities would rebound rather substantially, and especially the growth stocks and technology firms that have really been the leaders to the downside so far this year. This would do a lot of good to help the multiple compression that we have seen there. Again, yields are going to fall in this scenario as well, with the Fed being a little bit less aggressive, but not too terribly far. And credit spreads would contract pretty meaningfully. And so hopefully this is a kind of a helpful framework in terms of how we're thinking about sort of where things can go. I would just say, in terms of probability weighting, and this is quite a fluid type of situation, but that medium term that things get better slowly is probably about a 70% outcome in my mind today. That high risk, things get worse quickly, is probably about a 20%, maybe 25%, which is leaving, a 5 to 10% for that things get better quickly, that very low kind of exogenous, very difficult to predict type of risk. And so hopefully this is a helpful framework in thinking about that, and how, what signposts we're looking for and what the market implications are going to be sort of across these three scenarios. And so that's, I'll just leave you with one other thing, that the last thing that we're watching, kind of across the board here is just how the consumer is responding to these sorts of things. As I said before, really interesting dichotomy between the way they say they feel and the way that they actually feel, or the way that they objectively are in terms of their financial health. And so that's a just inherently unstable situation that can resolve itself in a couple of different ways, and it's really, really hard to predict. And so that's something that my team is spending a lot of time looking at, probably more than I ever have in my career. And certainly we're going to be, publishing things around that as we see kind of where we're going and adjusting our portfolio positioning accordingly around those types of things. So I'll pause there. I know I just threw a lot at you, and I wanted to leave some time for questions. I think that we have a bit of time here. Would love to open it up. I'm sure you have questions, and I'd love to be a help. Thank you, guys.
Hey, we got Zach online, so if you have a question, feel free to jump in. I mean, just take yourself off of mute and ask him any question. I mean, before y'all got to come in, we were joking around and everything. But in all seriousness, I mean, ask away on questions. So here's my question for you, Zach, is, looking at, we've got the headlines right now. We've got COVID, we've got Russia, Ukraine, we got China. But, if we're looking at all those charts that you pulled up, there's nothing that we really haven't seen before. It just seems like there's just a different headline right now. I mean, you referenced 1981. It's like, well, we've seen this before. We've seen inflation this high. We've seen Russia invade. So, I mean, is this something new that we, all of a sudden we're like, oh my gosh, what is this?
Yeah, that's a great question, Kyle. And I would say no. In the main, this is nothing new. But what is new is the fact that all these things are happening at once. So it's kind of like, any one of these particular, for instance, inflation is a great example of that, right? We were starting to see some signs that inflation was starting to slow down towards the beginning of this year. And then you had the situation in Russia, commodity prices go through the roof, energy prices go through the roof. There are very few, if any, like really good solutions for those types of things in the short term. Any kind of fix around energy, especially for Europe, but really for the globe, is a multi-year type of situation. And so, that threw a wrench in that type of dynamic that we saw starting to improve. So I would say what is new this time around is just the confluence of all of these different events. And that's partly why we are, looking in terms of, different scenarios rather than like, say this is exactly how we think we're going to evolve, because in that kind of situation with a lot of different cross currents and a lot of things happening at the same time, you have to be humble. The last 2.5 years has made a fool of anyone that was making this is exactly what's going to happen with the economy, and this is how COVID's going to evolve, or all these different types of things. So what we're trying to do, and certainly the way that we're managing our portfolios, is trying to be nimble in this environment, and take opportunities where we see them, but generally be positioned on the more defensive side of things, just because of how uncertain the overall environment is.
Looks like we've got a couple of questions in chat there, if you can see that, Zach.
I can, yeah. So I got one around the midterm elections. And specifically, as we get closer to that, is there anything legislation can do to kind of fix some of the problems that we have in the short term? And I would say, and I hate to be the bearer of bad news, but likely no. We've gone through essentially one of the most aggressive in terms of stimulus and interference in the economy periods in generations, quite frankly, over the last 2.5 years, in terms of the government shutting down the economy, $6 trillion worth of stimulus that was distributed to individuals and businesses, the amount of monetary stimulus that the Fed did, and whether the causation is there or not is kind of irrelevant. The mood and the environment is just not one that's conducive to really big type of legislation. And so, no, I don't think there's like a legislative fix that's going to come down the road here, kind of no matter really who takes over. We have one party in power now. If we get a split in terms of the House and the presidency, which is certainly kind of the general expectation in betting markets. And I'm not a politician or a political analyst, but that's kind of my general expectation as well. Generally, the party in power gets punished if things are not going well. And if you ask people how things are going, they say they're going poorly. And so, is that going to really change very much after the midterms? I tend to doubt it. I don't think that's not something. Certainly, we're looking out for it, and there are a couple areas like drug pricing and a few different impacts on the healthcare sector that may be important. But at a broad level, at a broad economic level, I really don't think it's as important as some of the other things I talked about here today. Let's see, another one about shooting war with either Russia or China and the impact on the U.S. economy. That's would generally be quite different, I think, than what we've experienced there over the last 2.5 years. We've been essentially, while people have been locked down, not had to make a ton of different sacrifices in terms of their day to day outside of that. And so, if we were to fully mobilize, I mean, first of all, I really do not wish this would happen at all. But if we were, I think it would require sort of a real war footing for the economy, which is really just going to change the overall environment. Making predictions or what the market would do in that type of situation, I would say generally it would increase risk and probably lower kind of corporate and economic growth in favor of ability to make war. But that's a low confidence prediction there. Certainly one that I hope does not come to pass.
At this time, we'd like to make another call for questions. We really appreciate Zach being here, and we want to make good use of his time. Anyone else could either unmute and ask a question live or add something to the chat box.
I just got one from Spencer, and actually this is a great question, especially because of the likelihood that we're going to get a second negative quarter of GDP when it's released in about 3 weeks at the end of the month. And so, I would say that right now there's a lot of sort of fear mongering around. We've shifted from fear mongering around inflation, especially since pump prices are starting to come down. Pretty meaningfully. They've been coming down for the last 3 or 4 weeks, thankfully. So now we're starting to talk about growth. Everyone says, "Oh, are we in a recession? We're going into a recession. We're already in one." All that type of thing, and it's going to be very confusing, I think, when we have potentially a negative quarter of growth in Q2. We had negative growth in Q1, and people are going to say that's 2 consecutive quarters of negative GDP. Therefore, we are in a recession. And I would say maybe technically by that technical definition, but if you look at things like the labor market, we added 1.1 million jobs to the economy on net in the second quarter of this year. We added 1.6 million on net in the first quarter of this year. That just does not seem like a recession to me, especially since in the 3 months before COVID hit, so in the normal state of the economy in 2019, where we had no idea what was coming down for us, in March of 2020, we added 900,000 jobs. And so if you look at the labor market, if you look at the way people are spending, if you just go out to a restaurant or try to travel, it certainly doesn't feel like a recession in that sense. And so I would just urge you to kind of use common sense and not get caught up in this technical definition, because it is technical, unfortunately. But a big reason that the GDP was negative in the first quarter of this year and is likely to be negative in the second quarter is due to trade, because we are importing more than we export, and the reason we're doing that is because we're building up inventories. And the way GDP accounting, which is what I showed earlier, the way GDP accounting works is if you build up inventories and you don't sell them, that actually is counted as negative growth. When you sell them, that's positive growth, but it's negative growth, as you build them up. And so, does that feel like a recession to you and me? No, I don't think so. And so I would just say that's one thing that we're trying to be, and we're putting out some pieces around that, and trying to do some things on social media and that type of thing that talk to that in a really digestible way, because it is a nuanced concept, but I think it's really important for thinking about it. As I say, in terms of a real recession, growth meaningfully slows in terms of for the average person. I do not think we're in one now, and I do not think we're going to be one in the next 6 months. I think there's too much momentum in the economy to see that. So hopefully that answers your question, but it is kind of a tough time to just be reading headlines, because you can pick and choose anything you want to kind of make things seem awful or make them seem great. And so, slow and steady, I think in that case, tends to win the race.
I really appreciate you concluding on that topic, Zach, because really it ties back into earlier how you're looking forward. You've got 3 scenarios you're keeping your eye out for. And it certainly seems like we're headed towards technical recession, but I've heard some fear from client voices, using that word, and yet you highlighted 2, 3, 4 points of strength in the economy. So it's not as fear. We're not returning to the 70s,
right?
With high likelihood.
And David, I would say too, different recessions are different. So if I look at S&P earnings, and if we're going to, translate this into kind of what your investment portfolios are doing, in the great financial crisis, the one that is kind of seared into everyone's mind because of how painful that event was, earnings declined 50%. S&P 500 earnings declined about 50%. In the tech bubble, they declined about 25%. But there were plenty of, the recession around the Kuwait War, earnings declined 20% in the 80s. Some of those recessions, actually the ones that the people talk about where Paul Volcker raised interest rates so high, you actually had declines like, 5 to 10% in earnings. And so all I'm saying there is there's a wide swath of like kind of what a recession actually means for, the earnings power of companies. And it's not always kind of that 2008 experience that is so dramatically kind of seared into our minds. And so I think that's helpful for keeping in the back of your head as well.
Yeah. Wonderful. We need a speaker like you every time, Zach. Yeah. As a preview, next month we will be touching on history of the markets, and so that it ties right in. But unless there are any other, I don't see any other questions showing up in the chat queue. Unless anyone else wants to speak up, I just want to appreciate our folks at Horizon Investments, Matthew and Zach, for your contribution today. I appreciate you guys laying things out as clear as can be. And it said, we appreciate your support in helping us to educate our clients.
Well, thank you all for having me today. It's been great.